Imagine running a vital, civilization-sustaining business,
Okay.
and every single year, you lose 10,000 crore rupees.
Wow. Yeah, that's just a staggering amount of money.
Right, and you aren't losing it to, like, a clever competitor or some sudden shift in consumer tastes.
No, it's literal leaks in the system.
Exactly. Rampant, unchecked theft. A supply chain that is essentially bleeding out into the dirt before the product even reaches the cash register.
Which is a crazy visual, but yeah, it's accurate.
So today, we're looking at the Indian power grid. And more importantly, we're looking at the one company attempting to plug that hemorrhage.
Because it is a financial and infrastructural drain on a scale that is genuinely difficult to conceptualize, unless you really look at the raw physical realities of how power is distributed.
Right. So welcome to the deep dive. We are unpacking a stack of sources today. We've got research notes, financial breakdowns, industry analyses, and it's all centered around Genus Power Infrastructures Ltd.
Yeah, they're India's largest smart meter manufacturer.
So our mission today is to figure out how this specific company is positioning itself to capture a government initiative worth an incredible 2.3 to 2.4 lakh crore rupees.
It's a huge pie.
It really is. And we're tracking their evolution from a traditional hardware manufacturer into what is essentially a digital toll road operator for the nation's electricity data.
Because the transition they're attempting is incredibly complex, we are really looking at the intersection of shifting government policy, a giant national infrastructure overhaul, and next-generation IoT technology.
So if you're listening to this, you might be asking yourself why you should dedicate an hour to understanding a smart meter company in India.
Right. Why does this matter to you?
Exactly. And the answer is that modernizing the grid is really the defining global infrastructure challenge of the 21st century.
Yeah. As the world transitions to renewables and urbanization accelerates, the legacy grid is just failing.
Right. So understanding Genus Power is basically a masterclass in how a single enterprise can capture a 70% share of a critical niche market while navigating, intense bureaucratic hurdles and staggering capital requirements.
I mean, the operational playbook here applies universally. It's a real-time study in building competitive moats, structuring infrastructure capital, and just executing under extreme regulatory pressure.
So let's start with the scale of the problem, because before we get into how Genus makes money, we really have to understand the 2.4 lakh crore rupee renovation.
Yeah, we have to look at the catalyst.
Right, the Revamped Distribution Sector Scheme, the RDSS. The Indian government has mandated the installation of 25 crore smart meters nationwide by 2027.
25 crore meters. We're talking about 250 million individual units here.
It's just a mind-boggling number.
It really is. I mean, the logistics of simply manufacturing, shipping, and installing 250 million physical devices across a geography as vast, densely populated, and topographically varied as India, it's a logistical undertaking with very few historical parallels.
But the government isn't pushing this just because they want fancy digital screens on the sides of houses, right?
No, not at all.
They're pushing it because of the bleeding I mentioned at the top of the deep dive.
Yeah.
The sources point to AT&C losses, so aggregate technical and commercial losses, as the primary driver here.
Right. And in India, those losses average between 15 and 25%.
Which is wild. Let's break out what that actually means on the ground.
Well, for every 100 units of electricity generated at, say, a coal plant or a solar farm, up to a quarter of it just vanishes before a utility can ever issue a bill for it.
A quarter.
Yeah. Now, a portion of that is technical dissipation, so power literally lost as heat as it travels across aging, inefficient transmission wires.
But the vast majority of that 15 to 25% gap is commercial loss.
Exactly. Commercial loss.
Meaning theft and billing failure.
Yeah, that's exactly it. It's manual meter reading errors, unbilled consumption, and just outright theft.
Like people hooking physical wires directly onto local transformers.
Yes, literally bypassing the analog meters entirely. Or, meter readers being bribed to record a lower consumption number than what the analog dial actually shows.
Wow. So what does a healthy grid look like, globally speaking? Because 25% feels catastrophic.
It is. Globally, a well-functioning modernized grid operates with about 5 to 8% losses.
Okay, so the Indian power sector is operating at 3 to 5 times the global standard for inefficiency.
Right. And that inefficiency flows directly into the second major policy driver, which is the intense financial stress on utility cash flows.
The state distribution companies, the discoms.
Yeah, the discoms are drowning. Currently, these discoms owe power generation companies around 1.5 lakh crore rupees.
Wait, So the state companies that distribute the power owe the companies that generate the power an amount so large it threatens the solvency of the entire energy ecosystem.
Yeah, the math leaves them no choice. If you lose a quarter of your product to theft and technical failure, and your billing cycles are constantly delayed or wildly inaccurate, your operating cash flow just evaporates.
They just can't collect enough.
Exactly. The discoms simply cannot collect enough revenue to cover the cost of the power they are legally obligated to purchase and supply.
Which perfectly explains the third secular driver mentioned in our sources, the prepaid push.
Yeah, the RDSS is heavily incentivizing a shift to prepaid metering.
This feels like a fundamental rewiring of the psychological and financial relationship that citizens have with electricity.
It totally is. Under the current postpaid system, electricity is often treated as an entitlement. The billing is loose, enforcement of shutoffs for non-payment is politically fraught, and the cash conversion cycle is terrible for the utility.
But with a prepaid smart meter, it functions exactly like a prepaid mobile phone plan. Yeah.
Exactly. You load your balance digitally. When the balance hits zero, the meter's internal relay physically disconnects the power.
And then you top it up and the power instantly comes back on.
Right. The utility gets the cash before a single electron is consumed.
It reverses the working capital cycle for the discom entirely. Suddenly, they're sitting on positive float instead of chasing bad debts.
It's a game changer. However, the behavioral shift required is immense. Currently, only about 1.9% of all installed meters in India operate in prepaid mode.
That's tiny.
Yeah, moving hundreds of millions of households from a loosely enforced post-paid paradigm to a strict digital prepaid system is going to require immense political will and flawless technical execution.
And all of this is happening against a backdrop of rapid urbanization. India's urban population is growing at a 2.5% compound annual growth rate.
Which means a lot of new homes.
Right. The sources project they will need 40 to 50 million entirely new grid connections by 2030 just to keep up with urban sprawl.
So you have an infrastructure system that is bleeding cash, burdened by legacy debt, forced into a total billing paradigm shift, and simultaneously required to expand its footprint by tens of millions of nodes.
It's a lot. And the smart meter is positioned as the silver bullet for all of this.
Yeah, it really is.
It stops the physical tampering by sending real-time alerts the second someone tries to bypass it. It eliminates the human meter reader entirely, wiping out that layer of bribery and error, and it enables the prepaid functionality.
Well, that is the architectural theory anyway.
Right.
The execution reality, however, is where the story gets incredibly nuanced. Let's look at the actual penetration gap.
Okay, let's do that. We have this 25 crore mandate by 2027. Where do things stand as of the mid-2025 data in our sources?
Out of the 25 crore target, only about 4.76 crore meters have been physically installed.
Okay, so that's roughly 20% of the way there. It's behind schedule, but not entirely stagnant.
Right. But the next metric is the critical one. Of those 4.76 crore physically installed meters, only 1.34 crore are actively communicating with the central utility systems.
Wait, I need to pause on that. Only 1.34 crore.
Yep.
So out of the 25 crore government mandate, only about 5% are actually installed, active, and sending data back to the billing servers.
That is correct.
Wow. This sounds like a colossal failure of execution. Putting a smart meter on a wall that doesn't talk to the network is just hanging up a very expensive digital paperweight.
Pretty much.
It defeats the entire purpose of the RDSS. So my question is, why are they failing to communicate?
The breakdown happens at the integration layer. Installing the physical hardware is the easy part. The friction lies in the communication architecture.
Okay, so?
Well, these meters usually rely on either RF mesh networks or cellular networks, like 4G or NB-IoT, to transmit data back to the utility.
Right.
If the telecom coverage in a rural village is spotty, the meter can't connect.
Oh, that makes sense.
Yeah, and if the state utility's internal servers aren't properly configured to ingest millions of incoming data packets every hour, the system drops the connection. The integration of the physical meter with the head-end system software is where the deployment is bottlenecking.
So, to use an analogy, this isn't like swapping out a broken pipe. This is like trying to replace every single cash register in a nationwide retail chain while the stores remain open 24/7.
Yeah.
Exactly.
And realizing half the stores don't have a stable internet connection to process the credit cards.
That is a highly accurate way to frame it. The systemic friction is intense, but here is the crucial analytical pivot.
Okay, lay it on me.
While a superficial reading of that 5% communication rate might suggest the entire government mandate is failing, For a highly competent manufacturer like Genus Power, it represents the ultimate validation of their long-term market opportunity.
Oh, I see. Because the mandate isn't going away.
Precisely. The central government is not backing down from the 25 crore target, and the discoms cannot survive financially without achieving it.
So they have to figure it out.
Yeah, that 5% execution rate simply means the runway ahead is virtually untouched. You are looking at a greenfield open market of roughly 22.5 crore units waiting to be deployed.
The unexecuted gap is essentially a built-in revenue backlog.
In absolute terms, it represents an open market worth $15 to $20 billion.
That's a staggering amount of money. It is, and the delays caused by smaller, incompetent players failing to integrate their meters just consolidate the future pipeline for the players who possess the engineering chops to actually make the hardware talk to the software.
Which brings us to the core of Genus Power's strategy. How do they actually extract value from this $20 billion open ocean? Let's dive into their digital toll road playbook.
Okay, let's do it.
The sources indicate Genus operates through three main verticals.
Right. The foundational vertical is their smart metering solutions business. This encompasses the physical manufacturing of single-phase and three-phase smart meters.
And these are fully IoT-enabled bidirectional devices, right?
Yes. They also manufacture prepayment meters, net meters for solar grids, and are expanding into gas and water meters.
And it's not just the plastic and silicon. This vertical includes the software suite, right?
It does. They develop the head-end systems, or HES, and the meter data management software, the MDM.
Let's actually unpack how those two pieces of software interact, because throwing around acronyms obscures what's actually happening.
Fair point.
How does a meter talk to a billing department?
Think of the HES as the universal translator. You have millions of smart meters out in the field, constantly pinging raw voltage data, tamper alerts, and consumption metrics over cellular networks.
Okay.
The head-end system sits at the utilities data center, receives all this chaotic raw telemetry, and translates it into standardized digital packets. It manages the actual two-way communication link with the device.
Okay, so the HES maintains the connection and translates the raw data. Then what does the MDM do?
The MDM, the meter data management software, takes those translated packets from the HES and turns them into actionable business logic.
Meaning it actually bills them.
Yes, exactly. It figures out which customer account that data belongs to, applies the correct tariff rates, generates the bill, and interfaces with the utility's broader ERP system. The MDM is the brain that monetizes the data that HES collects.
Got it. So Genus is selling the hardware, the translator, and the financial brain. What is the second vertical?
Engineering, construction and contracts, or ECC. This is traditional legacy infrastructure work, building substations, erecting transmission lines, and executing rural electrification projects.
Our notes show this is a low-margin segment for them. It's mostly pass-through costs. It only makes up about 5 to 10% of their total revenue.
Yeah, it is largely legacy business. They maintain it because sometimes these EPC contracts are bundled with larger state utility tenders, but it is not where their strategic focus lies.
So where's the focus?
The true engine of their valuation, the crown jewel of Genus Power, is the third vertical.
The AISP vertical. Advanced Metering Infrastructure Service Provider.
Exactly.
This seems to be where they transition from being a company that just stamps out hardware to being an infrastructure concessionaire.
Yeah, the AMISP model operates on a structure known as DBF Euro. Design, build, finance, own, operate, transfer.
DBF Euro.
Okay. To understand why this is so revolutionary for a hardware company, we have to look at the old model. Historically, a state utility would issue a tender, buy 1 million meters from Genus, pay them a lump sum for the hardware, and then the utility's own workers would install them, maintain them, and run the software.
A completely transactional, one-off vendor relationship.
Under the AMISP DBF model, the utility essentially outsources the entire grid modernization process.
Wow.
Genus designs the network architecture, they build the physical meters, they finance the entire upfront capital expenditure, they retain ownership of the hardware, they operate the data network, the HES, and the MDM.
And they do this for an extended period, right?
Yeah, typically an 8 to 10-year concession period. Only at the very end of that decade do they transfer the underlying assets back to the state utility.
Wait, I want to linger on the finance part of DVF. If Genus is financing the upfront cost, they are paying out of pocket to manufacture and install millions of meters before the utility ever pays them.
Yes. Genus invests roughly 2,000 to 3,000 rupees per smart meter up front.
That adds up fast.
It does. If they win a tender for 1 million meters, that is 2,000 to 3,000 crore rupees out the door in capital expenditure and labor before they begin to see a single return.
Why on earth would a hardware manufacturer agree to front that kind of capital? That seems incredibly capital-intensive and, honestly, super risky.
Because the payoff is a guaranteed decade-long annuity stream.
Oh.
In return for fronting the capital and taking on the operational headache, the state utility agrees to pay Genus a fixed per meter per month service fee for the entire 8 to 10-year duration of the contract.
Okay, this is the light bulb moment for me. This is exactly the cell phone carrier model.
Yep, spot on.
When you go to a carrier, they subsidize the cost of the smartphone to lock you into a 10-year data and service plan. Genus is treating the smart meter like a subsidized handset.
Exactly.
They are eating the upfront cost to lock the Indian government into a decade-long service contract. They're building a digital toll road for electricity data, and they get to collect a toll every single month for 10 years.
That analogy holds up perfectly. They're willingly trading the immediate low-margin cash hit of a hardware sale for a high-margin, highly predictable, recurring annuity stream.
And they're leaning hard into this, right?
Very hard. The pivot is aggressive. This AMISP model now represents 60 to 70% of Genus's total revenue profile. They classify this recurring revenue internally as Facilities Management Services, or FMS.
And the scale of this toll road is immense. The order book detailed in our sources sits at roughly 27,000 crore rupees, covering 2.8 crore smart meters.
It's a huge backlog.
And they already have 80 lakh meters, so 8 million units, physically installed and fully integrated into these FMS systems.
The backlog is formidable, absolutely. But it introduces a glaring mechanical problem if you look at the balance sheet required to execute it.
You mean the capital requirement?
Yeah.
Because if they're fronting 3,000 rupees for every single meter and they have an order book of 2.8 crore meters, the arithmetic there is terrifying.
It really is.
We're talking about tens of thousands of crores. A mid-sized domestic manufacturing firm does not have the balance sheet to act as an infrastructure bank for the Indian government. Where are they getting the money?
Well, they realized very early on that traditional domestic financing would bottleneck their growth. So they secured what is arguably their most significant competitive moat.
Okay, what is it?
A partnership with GIC.
GIC, the Sovereign Wealth Fund of Singapore.
Yes. Genus formed an exclusive joint venture with GIC specifically designed to fund these AMISP rollouts.
Wow.
Under this arrangement, GIC committed $2 billion to fund the capital expenditure of the smart meter concessions.
$2 billion of foreign sovereign capital pouring into domestic Indian metering. That is wild. How is the joint venture structured?
The equity split of the funding platform is 74% GIC and 26% Genus. But the brilliance of the arrangement is in the operational mechanics.
How so?
The joint venture acts purely as the financing vehicle. It then turns around and contracts Genus Power to actually manufacture the meters and contracts Genus Power to operate the network.
Oh, I see.
Yeah, so Genus retains the entirety of the manufacturing margins and the operational service revenue, while GIC shoulders the bulk of the upfront capital risk in exchange for a steady, sovereign-backed infrastructure yield.
Let me put myself in the shoes of a competitor. Say I run a rival metering firm in India, and I see Genus winning these giant DB-FID contracts.
Right.
I have a good product. Why can't I just take my government tender to a consortium of local Indian banks, secure a massive loan, and fund my own AASP rollout? Why is the GIC deal such an unreplicable moat?
To understand that, you really have to look at the strict limitations of the Indian project finance ecosystem. To compete at the scale Genus is operating at, you need access to upwards of 10,000 crore rupees in rolling capital.
Okay.
Domestic Indian banks operate under strict sectoral lending caps mandated by the Reserve Bank of India. They cannot just lend infinitely to one sector.
Especially the power sector, right?
Exactly. The RBI and domestic banks view the power sector, and specifically the state discoms, as highly toxic debt.
Because of the arrears we talked about.
Right. We already established that the discoms are 1.5 lakh crore rupees in arrears to generators. A domestic bank looks at an AMSP tender and sees that the ultimate counterparty responsible for paying the 10-year annuity is a bankrupt state utility.
So they just won't lend.
Or the risk premiums they demand, if they lend at all, make the math unworkable. I mean, even Genus itself utilizes 93% of its 816 crore rupee domestic working capital limit just to manage its day-to-day factory operations.
So the domestic banking system simply lacks the appetite and the capacity to absorb the upsent capital shock of a nationwide RDSS rollout.
Yes.
Having the sovereign wealth of Singapore on your side is essentially a cheat code.
It totally is.
Genus can walk into a bidding room for a state tender and say, we don't need you to pay us up front, and you don't need to worry about our ability to fund the build. The Sovereign Wealth Fund of Singapore is underwriting the capital expenditure.
Yeah. It entirely removes the primary barrier to entry that chokes out 90% of the competition. But financial engineering is only half of the moat. The other half is deeply physical.
The manufacturing scale.
Exactly.
Our sources detail 6 fully integrated manufacturing facilities located in Jaipur, Haridwar, Guwahati, and Kotputli. Their combined annual capacity is currently 18 million meters a year.
And they are in the process of scaling that capacity to produce 50,000 meters a day.
A meter every 2 seconds, nonstop. That is just incredible throughput.
It is. Achieving that requires extreme factory automation. They rely on advanced surface mount technology lines for the internal circuit boards, automated precision molding for the casings, and rigorous automated testing bays.
So they're not just assembling parts.
No, they aren't just slapping their logo on white-labeled components sourced from third parties. They possess a deep, proprietary technology stack holding over 50 patents.
The research notes specifically highlight a proprietary remote reading technology they developed that allegedly reduces operating costs by 20%.
Which is huge.
Yeah, when your entire business model relies on maintaining profitability over a 10-year fixed-fee service contract, shaving 20% off your network maintenance costs is a giant margin enhancer.
And the vertical integration extends to regulatory approvals as well. They were the first company in India to secure STS certification for prepayment meters.
What's STS?
It's a crucial global standard for secure token transfer in prepaid utility billing. They are also the only domestic firm holding BIS certification for smart gas meters.
Okay, wow.
Furthermore, they develop their own communication modules in-house, ensuring the physical hardware communicates flawlessly with their proprietary head-end systems.
Which naturally brings us to the final layer of their defensive moat, the switching costs.
Think through the operational reality for a state discom.
Yeah.
Suppose Genus installs 2 million meters across a major municipality. They integrate all 2 million nodes into the Genus proprietary head-end system. They link that HES to the Genus meter data management software. They spend months training the utility's entire billing and IT staff on the Genus dashboard.
And if a competitor comes along in year 5 and offers a slightly cheaper meter, the utility isn't going to switch. Ripping out that entrenched digital infrastructure would be an IT catastrophe.
It would paralyze the utility's revenue collection for months. The data migration risks, the hardware incompatibility, the retraining costs. The switching friction is so high that once Genus integrates its software layer, it effectively secures the 10-year annuity.
And heavily biases any future expansion tenders in their favor.
Exactly. They transform themselves from a replaceable vendor into an irreplaceable infrastructural partner.
They have a formidable setup, deep pockets from GIC, unmatched manufacturing throughput, proprietary software, and a business model that creates intense vendor lock-in.
It's strong.
But no moat is entirely unbreachable. Let's step into the gladiator arena and look at the competitive landscape. Who are they actually fighting in the trenches for these tenders?
Genus is currently the undisputed leader. They hold roughly 27% of the overall Indian metering industry.
Right.
But when you narrow the focus to the specific segment driving the future, so smart meters, they command an astonishing 70% market share.
Capturing 70% of a nascent government-mandated infrastructure rollout is just staggering. So who makes up the remaining 30%?
The primary historical challenger is an unlisted entity called Secure Meters. They hold about 15 to 18% of the smart meter market.
Okay.
They have a tremendous legacy brand, very strong roots in analog metering, and solid engineering capabilities. However, their weakness lies in the AISP financing transition.
They don't have a GIC.
Right. Without a $2 billion GIC-style war chest, they struggle to match Genus's scale when tenders demand DBF-to-OT capital structures.
Then you have players like HPL Electric, holding around 10 to 12% share. Again, competent in engineering and procurement, but lacking the sheer scale of the Genus order book.
Exactly.
But what about the really big, deep-pocketed conglomerates? The Indian infrastructure space is dominated by titans. Surely they aren't ignoring a 2.4 lakh crore rupee pie.
No, this is where the landscape gets highly combative. The emerging existential threat to Genus is Adani Energy Solutions.
It's impossible to talk about Indian infrastructure without Adani entering the frame.
Very true. Currently, Adani holds a relatively small 5 to 8% share of the metering market. But market share metrics are backward-looking.
Right.
Adani possesses the one weapon that secure meters and HPL lack, an infrastructure-backed balance sheet large enough to rival the GIC partnership.
So they can self-fund.
Yes, they are rapidly scaling their capabilities and aggressively targeting the largest AMISP tenders.
But why would Adani care about manufacturing plastic meters? Don't they operate at a much higher level in the energy stack?
You have to look at their strategic game theory. Adani wants to own the entire power value chain, generation, transmission, distribution.
And the meter is the final link.
Exactly. The smart meter is the final, critical node that connects the entire grid to the end consumer. Adani might be willing to take a loss on the hardware or underbid on an AMISP tender simply to acquire the data flow and the grid control, relying on their broader infrastructure portfolio to absorb the margin hit.
That's a scary competitor.
Yeah.
What about foreign competition? If this is a $20 billion open market, why aren't the global heavyweights, companies like Schneider Electric or Lonza plus Gier from Switzerland, sweeping in and dominating with superior technology?
While the global players dominate premium, technologically mature markets in Europe and North America, but in the Indian market, they are largely sidelined by the procurement rules, specifically the L1 bidding system.
L1 meaning the lowest bidder wins the contract, regardless of nuanced technological superiority.
Exactly. Indian utility tenders are overwhelmingly weighted toward the lowest price. The global players, burdened by premium R&D costs and non-localized supply chains, simply cannot compete on unit costs with a vertically integrated domestic manufacturer like Genus.
So the L1 system basically acts as a protective tariff, shielding the domestic players from foreign technological dominance.
It really does.
But even within the protected domestic market, it seems like consolidation is inevitable.
It is accelerating. In the early days of grid modernization, state utilities would issue smaller, fragmented regional tenders.
Right.
Now, under the RDSS framework, states are issuing huge consolidated tenders. States like Kerala, Madhya Pradesh, and Tamil Nadu are floating single tenders for 50 lakh to 100 lakh meters at a time.
5 to 10 million meters in a single bid. Wow.
When the lot size is that large, it acts as a centrifuge. The smaller, informal manufacturers are violently spun out of the market.
They just can't keep up.
Right. They cannot secure the upfront financing, they lack the factory capacity to deliver 5 million units, and they completely fail at the IT integration scale required.
So the megatenders force the market to consolidate around the few players who can actually digest them. Genus, Secure, Adani, and HPL. Okay, so Genus sits atop a consolidating market, protected from foreign players by L1 rules and armed with GIC capital. But where are they vulnerable? If I'm an analyst looking for the chink in the armor, where do I find it?
Their greatest vulnerability stems directly from the very technology that makes their product valuable. It is a deep supply chain vulnerability, specifically regarding semiconductors.
Okay, walk me through the mechanics of that.
A smart meter is essentially a ruggedized computer. It requires a microcontroller unit, a specialized metrology chip to measure the voltage accurately, and a communication module to transmit the data.
Right, lots of chips.
Yeah, these are highly advanced electronic components, and India does not currently possess the domestic fabrication capacity to manufacture these chips at scale. Genus is entirely reliant on importing them.
So they are tethered to the fragility of the global semiconductor supply chain.
Yes. If a fab in Taiwan faces a production bottleneck or shipping lanes in the South China Sea are disrupted, Genus's assembly lines in Jaipur grind to a halt. But the more insidious vulnerability is the currency risk. Genus must purchase these imported components using US dollars, but they are selling their AMISP service contracts in Indian rupees.
Wait, if they're importing chips in dollars today and getting paid in fixed rupees over a 10-year contract, aren't they basically writing an open-ended currency swap?
Yes.
If the rupee depreciates against the dollar over the next 5 years, their component replacement costs skyrocket, but their monthly annuity payment from the state government stays exactly the same.
The underlying mechanism there is exactly what analysts fear. It creates a structural margin squeeze. Competitors who focus on basic legacy analog meters might rely on highly localized, rudimentary supply chains that shield them from foreign exchange risk.
But Genus is exposed.
By operating at the bleeding edge of the smart grid, Genus is fundamentally tethered to the USD-INR exchange rate for its most critical inputs. You can control the efficiency of your factory floor perfectly, but you cannot control macroeconomic currency fluctuations.
That is a fascinating systemic risk. Let's transition to how all of this strategy actually reflects on the balance sheet. Let's look at the financial engine. We know they are winning the orders, but how do these billions in order books translate to financial performance?
The top-line growth metrics are incredibly robust. Looking at the first half of fiscal year 2026, their revenue expanded by 132% year over year.
More than doubling revenue in 12 months is pretty extraordinary for a manufacturing firm.
It is, and they are maintaining profitability while scaling. Their EBITDA margins are stable at roughly 21.2%.
That's solid.
But the metric that truly demonstrates the leverage in their business model is the bottom line. Net profit grew by 185% in that same H1 FY26 period.
So profit is scaling faster than revenue.
Exactly. It demonstrates the operating leverage inherent in their vertical integration.
Because of the fixed costs.
Right. Once the fixed costs of those 6 manufacturing facilities are covered, every additional smart meter they push down the assembly line drops a significantly higher percentage of profit directly to the bottom line.
Okay, so 132% revenue growth, 21% margins, 185% profit growth. On paper, it looks flawless.
Yeah.
But there's a catch hidden in the cash flow statements, isn't there?
There is a severe tension hidden in the working capital metrics. Despite those stellar profit numbers, the company's operating cash flow is projected to remain negative until at least FY28.
How does a company grow profits by 185% but bleed operating cash for the next 2 years?
You have to look at the milestone-based billing cycle dictated by the government utilities. Let's walk through the cash life cycle of a single Genus smart meter under an AISP contract.
Okay, let's trace the cash.
Day 1. Genus utilizes its own cash reserves to purchase the imported microcontrollers and communication chips from overseas. Cash out.
Got it.
Day 30. They pay their domestic labor force to assemble the meter in Haridwar. Cash out. Day 60. They deploy field teams to physically install the meter on a residential wall in rural Tamil Nadu. Cash out.
So spending money.
Day 90. They integrate that meter into the central head-end system and successfully commission it on the network. Cash out.
And at this point, 90 days in, the utility hasn't paid them a single rupee.
Not a fraction of a rupee. Under the AISP structure, Genus can only begin to bill the utility after the milestone of a fully commissioned communicating meter is achieved.
Oh, wow.
And even after they submit the invoice, state discoms are notoriously sluggish in processing payments. It frequently takes anywhere from 6 to 12 months for the physical cash to actually hit Genus's bank account.
That is brutal.
The metrics reflect this reality. As of March 2026, Genus's working capital days stood at an agonizing 274 days.
274 days. They have to float the entirety of the hardware, labor, and software integration costs for 9 months before they see a return on their investment.
This is the precise reason operating cash flow is negative. The company is growing at such an explosive rate and installing so many millions of meters simultaneously that they are continuously pouring cash into new raw materials and fresh labor deployments while waiting nearly a year to get paid for the work they completed 3 quarters ago.
So, synthesizing this, they are wildly profitable on an accounting basis, but because their primary customers are lethargic government utilities, they are burning cash in the near term just to sustain the velocity of their own success.
Yes.
It is a strategic, calculated cash burn.
It is entirely strategic. It is the unavoidable frictional cost of scaling infrastructure at a national level. But surviving that 274-day float requires capital.
Which means they have to take on debt.
Yes. Currently, their net debt sits at roughly 1,573 crore rupees, and projections indicate gross debt will peak at around 2,200 crore rupees by FY27 as the rollout reaches maximum velocity.
Carrying 2,200 crore rupees in debt while burning operating cash sounds highly precarious.
It would be if their underlying operations weren't so profitable. The mitigating metric here is their interest coverage ratio, which currently sits at a very healthy 13x.
So 13x means their operating earnings are 13 times higher than the interest obligations on that debt pile?
Correct. That 13x ratio provides a really good margin of safety. It proves that the core business generates more than enough operating profit to service the debt comfortably, giving them the financial breathing room to wait for the slow-moving government checks to clear.
I see the tightrope they are walking, which perfectly sets up the bear case. Let's look at what can go wrong. Because when I look at how the market is valuing Genus, investors seem to believe they are going to sprint across this tightrope blindfolded.
The market valuation is certainly priced for unmitigated perfection. Genus is currently trading at a forward price-to-earnings ratio of approximately 95x.
A 95x multiple. So investors are paying 95 rupees today for every 1 rupee of earnings they expect the company to generate next year.
Exactly.
That implies zero margin for error. The market expects the 25 crore mandate to be executed flawlessly, the 21% margins to hold steady against Adani, and the discoms to pay their bills on time forever.
And when a stock is priced for perfection, the slightest operational slippage can cause severe multiple contraction. The primary domino that could trigger that is regulatory risk.
Which means what, exactly?
Specifically, slippage in the RDSS timelines.
What happens if the government delays the mandate?
Well, the entire Genus growth narrative is predicated on the central government enforcing the 2027 deadline. However, under the Indian constitution, electricity is a concurrent subject. While the central government provides the funding and the mandate, the individual state governments are responsible for the actual execution and procurement.
So state-level politics can derail a national mandate.
Constantly. If a state government delays issuing a tender because they are facing budget constraints, or if a local election cycle causes political pushback against the concept of prepaid meters, which voters often resent, the procurement pipeline stalls.
Not if the pipeline stalls.
Genus's factories, which are calibrated to churn out 1.5 million meters a month, suddenly sit idle. The huge fixed costs of maintaining those idle factories would crush their operating margins instantly.
And what about the solvency of the customers themselves? We established that the discoms are 1.5 lakh crore rupees in debt. What happens if they just stop paying Genus?
This is the existential risk. Assessing this objectively, without delving into the politics of state governance, the financial condition of many state power boards is fundamentally broken.
It's a pure receivable risk.
Exactly. If a distressed discom stretches that 274-day working capital cycle out to 365 days or 450 days, the cash conversion cycle breaks down completely.
And then what?
At that point, the 2,200 crore rupee debt burden required to float the operations becomes unsustainable, even with the GIC joint venture buffering the capital expenditure.
That's terrifying. And then we return to the gladiator arena, the L1 bidding wars.
Yeah. If Adani Energy Solutions decides that acquiring data and grid control is more important than short-term hardware profitability, they could begin aggressively underbidding on these state tenders. Genus would then face a brutal dilemma.
They either match Adani's low price and destroy their own 21% margin, or they hold their price, lose the contract, and watch their revenue growth evaporate.
If they choose to engage in a race to the bottom, their EBITDA margins could easily compress from 21% down to 15% or lower. If the margins compress, the financial model supporting that 95x PE multiple shatters.
But let me push back on the nature of these contracts. If 60 to 70% of Genus's revenue is now derived from these long-term AMI-SP concessions, doesn't the sheer size of these new statewide tenders create a terrifying concentration risk?
That's a great point.
Like if Kerala or Tamil Nadu float a tender for 100 lakh meters and Genus lose to Adani, doesn't that blow a hole in their growth projections for the entire fiscal year?
You have pinpointed the ultimate tension in the stock's valuation. The bull case assumes Genus will consistently win roughly 30% of all future tenders.
But they're so lumpy now.
Right. Because the tenders have consolidated from small regional batches into these statewide binary outcomes, the revenue pipeline is extremely lumpy. Winning a single megatender secures your factory utilization for the year. Losing a single megatender starves your operations.
The concentration risk inherent in these massive winner-take-all bids is profound.
It is high-stakes poker being played with national infrastructure.
It really is. So let's look past the immediate risks. Let's assume Genus navigates the tightrope.
Okay, let's assume that.
They survive the working capital squeeze, the discoms pay their invoices somewhat reasonably, and their technological moat holds off Adani's balance sheet. What is the next chapter? Where does a company go once it has digitized the Indian grid?
If they secure the domestic base, the subsequent frontiers are highly lucrative. The immediate evolution is fully transitioning into software and data monetization.
Shifting from building the toll road to analyzing the traffic.
Once you have successfully deployed 2.5 crore actively communicating nodes across a national power grid, you are no longer in the business of merely measuring consumption. You are generating a real-time, high-fidelity data lake.
And what do you do with that data?
That data can be used to predict transformer failures before they cause blackouts. It allows utilities to implement dynamic time-of-use pricing to manage peak loads across an entire metropolis second by second.
Oh, wow.
The advanced analytics layers Genus can upsell to the utilities carry software-like margins, far exceeding the profitability of the initial hardware deployment.
Data becomes the new oil. even in the electricity sector. What about geographic expansion? Are they permanently confined to the Indian market?
Not at all. The strategic roadmap involves aggressive expansion into Southeast Asia and Africa.
That makes perfect sense. Those regions are dealing with the exact same legacy infrastructure issues. Rapid urbanization, high AT&T losses, and rampant power theft.
The grid challenges are identical, and Genus now possesses a battle-tested playbook for executing DBFOD rollouts in highly complex, low-trust environments.
Are they looking at anything besides electricity?
They are diversifying beyond electricity, yeah. They are targeting significant export revenue from smart gas and water meters within the next 2 to 3 years.
Water meters. That is a fascinating adjacency. The mechanical engineering for a water meter is different, right? It has to operate on battery power since it can't draw ambient voltage from the line it's measuring, but the data architecture is the same.
Exactly.
And given global water scarcity, municipal water leakage is arguably a more pressing existential threat than electricity theft.
The total addressable market for municipal water modernization is incalculable. In fact, internal management projections suggest that their water meter volumes could eventually surpass their electricity meter volumes within the next 4 to 6 years.
Really? Surpass electricity?
Yeah, it is a logical, highly scalable, horizontal expansion of their core competency.
But executing on these future horizons requires relentless, stable leadership. Let's talk about the management team steering this ship.
Genus Power is fundamentally a family-run enterprise led by the Agarwal family. The chairman is Ishwar Chand Agarwal, and the chief executive officer is Rajendra Kumar Agarwal.
A family holding the reins of a critical national infrastructure firm.
Cool.
What does their skin in the game look like?
The promoter holding, so the percentage of the company equity owned by the founding family, is stable at roughly 39.3%.
That is a substantial block. It aligns their personal net worth directly with the long-term execution of the company.
Another highly positive indicator of stability at the top is the pledging metric. Currently, only 5.38% of the promoter holdings are pledged as collateral for external loans.
That is a crucial detail. In the Indian corporate landscape, high promoter pledging is often a glaring red flag for financial distress.
Definitely.
It indicates the founders are using their equity as a personal ATM. A low pledge rate implies financial stability within the family and heavily mitigates the risk of a sudden margin call forcing a chaotic change in corporate control.
It provides confidence in the structural integrity of the boardroom. However, as objective analysts, we must also acknowledge the blind spots in our data.
Right.
The public sources lack a few critical data points required for a perfect assessment.
What are we missing?
We do not have clear visibility into their historical return on capital employed, or ROCE, trends over extended cycles. Because they have pivoted so aggressively from traditional hardware sales into this capital-intensive AMSP-DB foot model, their historical returns don't provide a reliable roadmap for their future capital efficiency.
We are judging a new business model without a decade of historical data to back it up.
Additionally, we lack granular disclosures regarding specific executive key performance indicators. How exactly is the CEO's compensation structured?
Good question.
Is the executive team heavily incentivized for raw top-line revenue growth to capture market share, or are their bonuses tied to long-term margin protection and cash flow generation?
Without visibility into those specific KPIs, it is difficult to definitively judge whether their capital allocation strategy is perfectly aligned with minority shareholders over the long term.
That is a very fair critique. You have to verify the structural integrity of the vessel, not just marvel at the speed it's traveling. We know they are executing brilliantly in the present moment, but the granular details of their governance remain slightly opaque.
It is the final layer of risk in an otherwise remarkable growth narrative.
It really is.
Well, we have covered a staggering amount of ground today. Let me attempt to synthesize the journey we've taken.
Okay, let's hear it.
We started by examining a broken, bleeding national power grid. A legacy system losing tens of thousands of crores annually to technical inefficiency and outright theft. And we looked at how Genus Power is attempting to run an absolute infrastructural marathon. They are trying to physically and digitally transform an analog, loss-making Indian grid into a highly profitable 10-year annuity stream.
That is the core dynamic of their transition.
They have constructed an incredible defensive moat. They secure the sovereign backing of GIC, providing them with the billions required to front the huge DBFOT capital costs.
Yeah.
They built out a manufacturing scale capable of producing 18 million meters a year. They developed proprietary software that makes it an IT nightmare for utilities to ever switch vendors. but they are running a perilous race.
Very perilous.
They are in a constant grinding battle against lethargic utility payment cycles, the persistent threat of currency fluctuations inflating their imported component costs, and the looming specter of cutthroat tender competitions from infrastructure giants like Adani.
They are a company operating at the absolute leading edge of physical manufacturing and complex financial execution.
So, for you listening, the next time you walk outside your home and look at that gray plastic box attached to the side of your house, realize that it is no longer just a spinning analog dial recording your usage. It is the front line of a multi-billion-dollar digital infrastructure war.
Well said.
It represents a fundamental shift in how human civilization measures, monetizes, and controls its most critical resources.
It truly is the vanguard of the modern grid. And if I may leave you with one final thought to mull over.
Please do.
We have spent this entire deep dive analyzing the economic miracle of the smart grid, eliminating theft, predicting transformer outages, reversing utility cash flows, and saving billions of rupees. It is an undeniable infrastructural triumph.
Yes, absolutely.
But if companies like Genus succeed in their ultimate mission, putting a highly sensitive, constantly communicating node on every single home and business, thereby creating a perfectly mapped real-time digital grid.
Yes.
What happens when the utility companies or the data platforms managing them know exactly which appliances you are running and exactly when you run them?
Wow.
When the algorithms can identify the unique electrical signature of your air conditioner turning on, your television drawing power, or your electric vehicle charging in the garage down to the exact minute. The line between necessary energy efficiency and extreme behavioral surveillance is about to get very, very thin.
Wow. That is a completely different kind of diagnostic clarity. We will have to leave it there. Until next time.